So, picking back up with financing, of course, it's a different chapter, chapter 15. We're changing gears slightly, but not really. Here's the big change for going from 14 to 15. It's rather than talking about the mechanics of how an individual loan works, we're going to talk about loan programs. We're going to talk about financing on a bigger scale. But this is really just kind of a continuation of the same thing that we've discussed all morning with the finance stuff. And I appreciate you hanging in there, because I know finance it's a lot to digest, but I do find it's better to keep it together. If I thought it was like license law, where it was better to spread it out over like 4 different days, that's what we would do. But I've just found it, even though it's kind of a tough slog, it's better to keep your brain engaged on what we're doing with it. Before I forget, you are going to have a quiz tonight on these 2 chapters, and you have already in your OneDrive. So if you want to check on that while we're covering this afternoon, you have in your OneDrive in the math worksheets folder a math worksheet. I think it's called, I forget what it's called. What is it called? What do I name that thing? Interest and loan factor math. Yeah, that's what it is. Interest and loan factor math, and it looks like that. It's on the screen right now. So you should have that in your OneDrive folder as well. And there's quite a bit of math in there. If I were you, I would use there's 2 sections in there, like there are for all those worksheets, an in class and then a homework, just because of the different dynamic with in-person versus in this setting. What I would say is, if you feel real comfortable, just jump straight to the homework section and see if you can answer those, because there's a question of every type you could possibly deal with math-wise in that section. And once you feel like you've got 75-80% of the math nailed down in finance, then don't spend any more time on it. Don't try to be a perfectionist when it comes to the finance math, because you'll invest way more time than really is needed, and you may not even see that kind of a math question. So don't stress too much over that, but do work on that, and I'll post the answers to the math worksheet as well. But chapter 15 deals with loans on the big scale, lots of loans at a time. And that's where we have to talk about the difference between the primary mortgage market and the secondary mortgage market. And I would probably go out on a limb and say you will see a test question in the finance section about what is the difference between the primary mortgage market and the secondary mortgage market. What things separate the primary market from the secondary market. The truth is, they are completely different things. The primary market is where loans get made, where people borrow money from banks, from lenders, to use for purchasing property, for renovations, for whatever they do. But it's where the loans are being made. It's what you think of as the lending industry when you think of finance. It's people borrowing money from a lender. That's the primary market. The primary market makes money by fees, as we talked about, but also by collecting interest over the full life of the loan. That's how money's made in the primary market. And you could have bankers or brokers. The difference between the two is just that a banker can only lend one financial institution's money, whereas a broker has access to many financial institutions at one time. But then we get into the secondary mortgage market. And this is where I certainly think you could see a test question about the difference between the primary market and the secondary market. Is the secondary market, there are no loans being made. Nobody's lending money in the secondary mortgage market. Loans that have already been made are being packaged up together and sold to investors. They're being sold to investors, Now, just like anything else, if you sell something, the goal is to sell it for more than what you have invested in it, correct? I mean, if you own a shoe store and you're selling Cole Haan shoes, you pay Cole Haan a certain price for those shoes from the factory. By the way, my Cole Haans are so like ignored, right? Like you want to see crazy. If I opened the doors to that closet over this, my shoe closet's in my office. And yes, I said shoe closet. It's that bad. I have a problem. And I don't wear any of them in 4 months. I haven't worn them. Like I just look like, and they're all like, you know, container store racks and all neatly, and they look sad. There are lights in my shoe closet, so I can find the right pair. Yeah, it's bad. It's real bad.
You should see my closet.
It's really. I used to laugh at my mom because my mom had a shoe closet and I turned into her. I don't know how that happened.
How many pairs? How many pairs of shoes?
How many of Cole Haans or shoes total?
Total.
Oh, total? Counting tennis shoes? It's got to be 70 pair. That'd be my guess. Probably 70 or so. There's 40 pair of Cole. There's about 40 pair of Cole Haans. So it's bad. It's real bad.
Are they organized?
My shoes are like the most organized thing in my life. Like I don't know what it is about. Like the shoes get organized and nothing else does. Like, but the shoes are very organized, and they're very like color coordinated. Like
yes,
my shoes usually match my belt, and like I don't know when I turned into like a frat boy when I turned like 40. I don't know how that happened. I don't know what happened. It's just weird.
Get it, Travis?
But just yeah, and they look sad. But if you buy shoes, you buy them from Cole Haan. If you're the shoe store, you pay a certain price, and then when you sell them to the public, you have to sell for more because that's where your profit is, correct? Well, lenders work the same way. If they invest $200,000 in a loan, when they sell the loan, they don't want to sell it for $200,000. They want to sell it for more than that. And, you know, of course, the question is how much more can they sell it? Well, that's between them and the investor. And why is the investor willing to pay more than $200,000 for it? Because if you think about all the interest that's going to get paid over the life of that loan, that $200,000 loan could easily represent $350,000, $375,000, $400,000 in payments being made over the next 30 years. So an investor may be willing to come along and pay $215,000, $220,000 for that $200,000 note. And the lenders are happy to do that. They're happy to sell them to investors because then, and this is where the test question is probably going to come from. What happens in the secondary mortgage market? It's a way to put money back into the primary mortgage market. Because if the lenders can sell those loans and put that cash back in their pockets, they can make more loans. So it's just a way to keep the process moving. Matter of fact, one of the biggest lessons the United States learned out of the Great Depression was that banks not having money to lend makes any economic problem 1,000 times worse. Because at that point in time, there was no secondary mortgage market. Banks loaned their own money, and then they kept those notes until they were paid off. And so part of the economic recovery from the Great Depression was creating systems where banks could sell these notes. And so it just keeps money moving through the system. If you see that question, okay? You see that question. In the secondary mortgage market, you have basically one big player up here at the top, and then a bunch of also-rans and everybody else's. But this one up here at the top is the big dog in the secondary mortgage market, Fannie Mae. Now, that's not really the name of the company. Nobody names the company Fannie Mae. It's the Federal National Mortgage Association, FNMA. And because of that abbreviation, FNMA, somebody many, many years ago goes, oh, just call it Fannie Mae, and it's stuck. And so that's what's stuck around. Nobody calls it the Federal National Mortgage Association or FNMA. Everybody just says it's Fannie Mae. Clearly, this name was invented in a different time. I don't think it would be called FNM. I don't think it would be called Fannie Mae anymore. But that's what people came up with. And so it is affectionately nicknamed Fannie Mae. It's a company that does nothing but buy loans. That's it. They don't build stuff. They don't manufacture anything. They don't even sell anything. They just buy. But what they buy makes money because they buy loans. They buy millions of loans. Now, here's the thing, and this is what you need to connect in your brain. If Fannie Mae buys a loan from SunTrust, the person borrowed the money from SunTrust. The person is making their payments to SunTrust. They no longer owe the money to SunTrust. Who do they now owe the money to?
Fannie Mae.
Fannie Mae. So they're going to make payments to Fannie Mae. So all that interest that would have gone to SunTrust is now going to go to Fannie Mae. Which means as long as somebody pays that mortgage, Fannie Mae is going to make money. No question about it. There's no way they can lose. It just takes a long time for them to make that money.
I have a question, Travis.
Sure.
I had a Wells Fargo mortgage, and then I got notice it was bought out, but it was bought out, it said, by Bank of America.
Mm-hmm.
How does that happen if it's really Fannie Mae buying it? Do they reassign it?
Well, it might not be really Fannie Mae. It could be Bank of America, and then Bank of America may package it and resell it again.
Okay.
Fannie Mae's not the only one buying. They're just the biggest one.
Got it.
They're just the biggest source of the buying. Here's the thing about Fannie Mae, though. Fannie Mae is not a charity. Barbara said, does the borrower know this has happened? Yes, they notify you, but you don't have any say-so. They just notify you and say, now you owe the money to send your payments here. And that's what you do. Fannie Mae is there to make money. It only makes money if people pay the mortgages. So Fannie Mae tends to be relatively careful about the types of loans it will purchase. Fannie Mae tends to purchase loans that are made to what we consider well-qualified borrowers, people who make a big down payment, people who have good credit histories, people who have good incomes. These are not loans that you would be concerned about. Those are the kinds of loans Fannie Mae likes to buy. And that's the reason people have been willing to invest in Fannie Mae. So you might start to wonder, well, where does Fannie Mae get the money to buy all these loans? They get it from you. They get it from me. They get it from anybody who has a retirement account, a Roth IRA, a 401k, because Fannie Mae is a publicly traded stock. And most of your portfolios, if you have an investment portfolio at all, have some investment in Fannie Mae stock because it's a very solidly performing stock over time. And so lots of companies have their entire pension plans tied up in Fannie Mae stock. Lots of insurance companies use the premiums that you pay them for insurance policies to purchase stock in Fannie Mae to make money off of owning stock in Fannie Mae. You wouldn't believe the amount of money that gets invested in Fannie Mae, and they turn around and they buy mortgages with it. So they're just pooling these mortgages together, millions and millions of mortgages, and everybody making these payments all in and making money over time. That works really well for people who are well qualified as borrowers. Because now I'm going to let you in on a secret of the lending industry. It's not really a secret. Nobody just pays attention. The banks no longer care who they lend money to. Like at all. They don't care. Because they're not going to keep the debt on their books. They're going to sell the debt to somebody else. Obviously, they can't sell loans they make to really crappy borrowers. So when you hear that the bank denied you a loan, they didn't deny you a loan because they were worried about you not being able to repay it. They denied you a loan because they were worried they couldn't sell that loan after they made it to you. You see the difference between those two? Basically, if a bank can get somebody to say they will buy that loan, they'll make a loan to anybody. Well, right now, it's easy for banks to sell loans to highly qualified borrowers. Fannie Mae will buy every single one of them. They're begging the banks, make more loans, make more loans. The bank's like, well, listen, there's only so many 720 credit scores out there. There's only so many people who have 20% to put down out there. So we can't buy anymore because there's no more of those people. Is everybody following me on this? That's the inherent problem Fannie Mae has. It's just they run out of well-qualified borrowers. That's where a company like, and that's a problem for consumers. So we're going to talk about that. If you're a well-qualified borrower, you're not going to have a problem getting a loan because the bank's not going to have a problem selling your loan. But what if you're that first-time home buyer who doesn't have much of a down payment? What if you don't have perfect credit? See, you go and apply for the loan at Bank of America. Bank of America is going to contact Fannie Mae, and you know what Fannie Mae is going to say about that loan?
We're not buying it.
Not buying it. They don't have enough of a down payment, don't like their credit history, too young, too whatever. No, we're not buying that loan. And if they won't buy it, the bank won't make it. So that creates a problem for consumers, a lot of consumers. And that's where Ginnie Mae comes into the picture. Ginnie Mae, GNMA, stands for the Government National Mortgage Association. This is the U.S. federal government. Ginnie Mae is owned and operated by the United States Treasury. Ginnie Mae buys loans. Unlike Fannie Mae, Ginnie Mae was never created with the intention of making money. Ginnie Mae was created by Congress with the intention, now I want you to imagine this. Their mission, find the borrowers that nobody else will touch, and we'll buy those loans. Those are the loans we will buy. We'll buy the loans that you make to that first-time home buyer because we think that's important for the economy. We'll buy the loans you make to that person who doesn't have much of a down payment. We'll buy the loans you make to that veteran because we want to thank them for our service in the country and we don't want them to have to make a down payment. See, no, there ain't a bank in this country that would lend a VA loan if Ginnie Mae didn't exist because no, Fannie Mae won't buy it. And the banks won't make loans they can't sell. Are y'all following me on that thought process? They don't make a loan unless they know they can do what with it. As soon as they close the loan, what do they want to do with it?
Sell it.
Sell it.
And they won't make it if they can't sell it. So they needed somebody to buy those loans. And that's where Ginnie Mae came into the picture. Ginnie Mae buys what Fannie Mae won't buy. Not everything. They don't buy complete, garbage. But they buy loans that are significantly more risky. And Ethan is exactly correct. If Ginnie Mae didn't exist, it would be very hard for many buyers to break in as first-time home buyers because the old expectation was we need 20% down to buy a house. That when my parents built their first house, you had to have 20% to put down, 20% to put down. If we told first-time home buyers now they had to have 20% to put down because that's what Fannie Mae wants to see before they'll buy that loan? How many people will be renting until they were 70?
Everyone.
You know, it's just the reality of today's world. And so Ginnie Mae plays a very pivotal role. Now, are y'all ready for the David Copperfield reveal magic behind the machine moment here? Remember I told you these borrowers down here in this Ginnie Mae bucket, these are your first timers. These are your low down payment. These are maybe, you know, got some credit issues. And up here, this is your cream of the crop. Fannie Mae's got their nose turned up at all those people down there. Not buying those loans. They're too risky. What if I were to tell you that everything in this bucket, all of it, is going to get tied up together once a month and sold again? What if I told you that was going to happen? I mean, God, that's a lot of loans. I can't imagine who would be bigger than the United States Treasury, who would be able to buy that many loans. Guess who's big enough? The very people who turned their nose up at it the first time.
And that happens every month?
Every month. And here's why. Here's why Fannie Mae will buy them from Ginnie Mae, but not directly from the bank. Because Ginnie Mae guarantees them in the process. Ginnie Mae puts a warranty, a guarantee on these notes that they will not default. They put mortgage insurance on them. If you are Fannie Mae, what makes you feel better about buying a note? You want to make sure you got a good borrower. Well, guess what? Not only is the borrower now on the hook, but the United States federal government, the U.S. Treasury, is now on the hook for that loan. Is that now a loan you want to buy? Does that make sense for everybody?
Yes.
And that's how the process works.
Are these only like VA, veteran loans and things like that, or this could be anybody?
FHA, VA, USDA, all those government-backed loan programs, they all go in this bucket. And the government stamps a guarantee on them through Ginnie Mae, and then Ginnie Mae turns around and sells them to Fannie Mae once they're guaranteed. Fannie Mae wouldn't buy them without the guarantee, but once the guarantee's there, they'll buy them.
And the individual owner buys the insurance on the mortgage.
Well, and that's exactly right. I never said that the federal government was going to provide the insurance for free. They charge the borrower for the insurance, but it benefits the note holder, in this case, Fannie Mae eventually. You won't be asked questions about that on the test, but if you can understand that, you'll understand everything else in the chapter. If you can understand and see the big picture of that, you'll understand everything else we talk about when it comes to the secondary mortgage market and how these things work and how guarantees work. Because the best thing you could have as somebody who's buying loans is somebody guaranteeing their payment who you really trust. Guess who Fannie Mae trusts?
The government.
The United States Treasury. And that's who's guaranteeing payment of these loans.
But I want to make sure this. So the only thing that's securing these Ginnie Mae loans back to Fannie Mae is the fact that they have insurance.
That is correct. And they all remember, every loan still has the ultimate insurance, which is the property as collateral.
Right.
So this is insurance that, number one, the borrower will pay. Number two, if the borrower doesn't pay, you'll be able to foreclose on the property and get your money back. But if both of those things fail, then come back to us and we'll make you whole. That's what the government is guaranteeing here.
So it's taxpayer funded then?
It is largely a, I don't know how I want to say this. Taxpayer funded is not the right word. It's a taxpayer liability, because the theory is that the cost of the insurance, because the government does not provide this mortgage insurance to the borrower for free. The borrowers pay a significant monthly insurance fee to the government for this insurance. The theory is that it's self-funded, but obviously, if the crap were to hit the fan in a major way, it would be a pretty large liability on the part of the U.S. federal government.
Isn't Fannie Mae the government as well?
Fannie Mae is not the government, but can borrow money from the federal government. That's the other fail-safe for Fannie Mae. If they run out of cash to buy loans, they can borrow the cash from the U.S. federal government to continue to purchase loans.
Okay.
But they are not part of the federal government. They just simply have a line of credit with the federal government. Okay, that is the secondary mortgage market. But again, if you're asking the test, what's the purpose of it? Put money back in the primary market. All that selling of loans, eventually money flows back to the lenders who made the loans in the first place so that they can make more money. Latasha says, is this insurance PMI? It's a version of mortgage insurance. Take the P off, Latasha, because what you don't yet understand is that there are two types of mortgage insurance. There's government mortgage insurance and private mortgage insurance. They both function in the same way, they just come from two different places. This is the government version of mortgage insurance. There's also a private version of mortgage insurance, but this is, they function in exactly the same way. What is insurance for? Is in case things go bad. So what is mortgage insurance for? It's in case two things happen. Number one, the borrower defaults. But even then, mortgage insurance is not necessary, because what's the first line of defense for when the borrower defaults? What's the first line?
Foreclosure.
Foreclosure. That's what the lender's supposed to do to get their money back. Foreclose, sell the property, get your money back. Mortgage insurance is only there for the event that the borrower defaulted, the property's been foreclosed on, we sold it, and we're still short. This deficiency that we have, we want to file a claim against the mortgage insurance policy. That's what mortgage insurance is for. Is everybody okay with that? That description of mortgage insurance? Yes? No? Maybe?
Yes.
I
Okay.
guess why would you have private versus government
Just
if you have a Fannie?
who you buy it from. Just like why do some people choose private school and why do some people choose public school? It's all about
Okay.
what they're willing to pay and what it covers and what the costs are and, you know, that sort of thing. So in general, private mortgage insurance is cheaper than government mortgage insurance. Government mortgage insurance is more expensive.
Got it.
But government mortgage insurance will cover more risk. The government will insure borrowers that private companies will not insure. Okay. They may ask you on the test, what is a subprime mortgage? Well, a prime mortgage is a mortgage made to a well-qualified borrower. So a subprime mortgage is one made to one that is not so well qualified. So subprime just means loans that are made to borrowers that are not necessarily the most qualified borrowers. So let's talk about some different types of loans, different categories of loans, and how you learn to recognize them. The grandfather of them all is the conventional mortgage loan. Conventional always means, you know, expected, normal. Normal is probably not a good word, but most common. Conventional in this case means loans that do not have anything to do with the United States federal government. That is the definition of a conventional loan. Traditionally speaking, loans didn't have anything to do with the government. You borrowed money from a bank, you paid the money back to the bank, the government is not involved in that transaction. And that is still the absolute basic definition of a conventional loan. So conventional loans are not backed or insured or guaranteed in any way by the government. No government. That's how you know it's a conventional loan. If there is no government involvement, then they're conventional loans. The other type, guess what we call the other loans, by the way? Government-backed loans. So you have conventional loans, and then the opposite of conventional loans are government-backed loans. So your loan is one or the other based on simply, is the federal government in any way involved with your loan? The conventional loans are the ones that the government is not involved in. These are the ones that didn't need help. These are the ones that lenders have been making for the last 200 years because they are made to borrowers that lenders feel very comfortable with. We talked about how important down payment is. That's probably the biggest thing, the single biggest thing, not credit score. The single biggest thing lenders are looking at is down payment, equity, or loan to value ratio, because loan to value ratio is just the opposite of down payment. Which would you feel more comfortable with if you're the lender, as far as people being able to make their payment and not get in trouble? Which would you be more comfortable with? Somebody borrowing 80% of the value of the property, or somebody borrowing 95% of the value of the property? Who are you more comfortable with as a safe borrower?
80%.
80%. So that 80% loan to value borrower is a more well-qualified borrower than that 95% loan to value borrower is. And go ahead.
These are the loans that Fannie Mae buys? Or
These are loans that Fannie Mae will buy because these are the ones that are the safest. These are the ones that are made to people that have the best profile overall, highest down payment, best credit, best income history, all those kinds of things. Now, when you have a conventional loan, there are some characteristics that you can look for to say, yep, that's conventional. These are not the definition of conventional, though. The definition of conventional is very simple. Not related to what?
The government.
Government. Not backed or insured or related to the government. That's what conventional means. But there are some characteristics that help you recognize conventional loans. The loan to value ratio is usually lower. So we're usually not looking at 95% loan to value. You're usually looking at 90%, 80%, 70%. Though that's not always the case. There are 100% loan to value conventional loans. And that's why I say, don't think of this as the definition. These are just common characteristics, you know. Higher down payments, usually, with conventional loans. And that's because the lender wants the borrower to be somewhat invested. The magic percentage, and you do need to know this, the magic sort of line traditionally for conventional loans has been 20% down or 20% equity at any given time. Remember we said equity was just the difference between what you could sell it for at any given time and what you owe on it at that point in time. 20% equity. Well, give me the loan side of that. If we have 20% equity or somebody's putting 20% down, what are we letting them borrow?
80%.
So these people would be at 80% loan to value, LTV, or lower, 80%, 75%, 70% loan to value. When that's true, we usually call this an uninsured loan. Here's what uninsured means. It means the lender is so comfortable that you're not a risk that they could get their money back. And let's be clear why they're comfortable they could get their money back. It has nothing to do with your credit score. They're comfortable that if they had to foreclose, they could sell the property and get their money out. Does that make sense for everybody? Because they've only loaned no more than 80% of the property's value. So they feel they got that cushion that we can sell it, we can get our money. Very low risk. And because it's very low risk, they're willing to make that loan as an uninsured loan. Here's why that's a wonderful thing for the borrower. Guess who would pay for the insurance if the lender wanted insurance?
Borrower.
Lender.
It would be the borrower, not the lender. Lender's not paying for the insurance, even though it protects them. It would be the borrower paying for it. So when the lender says, okay, well, we can do this one uninsured, what happened was that loan, that monthly payment just became cheaper, a lot cheaper, because the borrower is not having to pay for insurance. And Latasha, to follow up on your question, this is where PMI comes into the question. Because these loans have nothing to do with the federal government, if a conventional loan does need insurance, it would get private mortgage insurance, or PMI. It would not get government mortgage insurance, it would get private mortgage insurance. But if somebody's willing to put 20% down, they can usually avoid having to have PMI. If they can't put 20% down, then it is very likely that they're going to be told they need mortgage insurance to protect the lender in the event of a default. Now, the mortgage insurance does not automatically pay just because there's a foreclosure. Remember, the property still has to be sold. If the property's sold and the lender gets all their money, there's no loss. There's nothing to file against the insurance. So there would only be a loss when it comes to the mortgage insurance if there's a foreclosure and if the foreclosure sale did not bring enough money, if there was a deficiency. Is everybody with me on that? That's when there would be this mortgage insurance claim. As I said earlier, the point at which this becomes necessary is 80% loan to value. If you're borrowing less than 80% loan to value, like over here on the left-hand side, the lender is not worried about this amount of the loan. They're not worried about that at all. And as a matter of fact, they're not worried about the blue amount of the loan either. That 80% loan to value, they feel comfortable they can get their money back. But once you get above 80% loan to value over here, up here, they are sweating. They're worried that if you defaulted and they had to foreclose, they might not get all their money. Is everybody with me on this so far? This is what you buy insurance for. You do not buy insurance for the whole thing. You are not insuring the whole loan. You are only insuring the risky part of the loan. Does that make sense for everybody? So if 80 is the cutoff line, would I need mortgage insurance if I went to 85% loan to value? Would I probably need to get PMI?
Yes.
Yes.
Yes. Would I need mortgage insurance on 85% of the property's value, or would I need only mortgage insurance on 5% of the property's value?
5.
5%, because that bottom 80, nobody's worried about that. They feel safe with that money. Does that make sense for everybody? So if I were to get a 90% loan to value loan, I would need insurance on 10%. If I were to get a 95% loan to value loan, I would need insurance on 15%. That's the amount of the loan that is protected, not the whole loan. There's no such thing as a mortgage insurance policy that protects the entire loan balance, just that top risky part.
Is this federally required if it's less than 80% that you have to have
No,
PMI?
it's not. This is going to be lender specific, but I can tell you who is going to require it.
The bank, the lender.
Well, and why is the bank going to require it? Because Fannie Mae is going to say, you loan 90% if you want to, but we will not buy it unless you force those people to have mortgage insurance that protects us.
Right.
And so the bank will make any loan they can sell. So if Fannie Mae says, got to have mortgage insurance at 90% loan to value, then the bank's going to say, you got to have mortgage insurance at 90% loan to value. If Fannie Mae tomorrow changed their guidelines from 80% to 90%, guess what would happen with every bank in the country? they would all change their guidelines too. Because the banks don't care. They're going to sell the risk. Once they've sold the loan, they don't care if you never pay. They got no risk anymore. So it's really about what Fannie Mae says is an acceptable level of risk. Does that make sense? Everybody okay? That's private mortgage insurance. And it's private mortgage insurance because it's on a conventional loan, which means the government is not involved in any way with the loan or the insurance of the loan. It covers some of the lender's risk, not all. Nothing covers 100% of the risk. It only covers that riskiest part. And that covers conventional loans. That's about all I think you'd be tested on with conventional loans. If these are the best qualified borrowers, what do you think their interest rates are going to look like, and their fees and those kinds of things? Are they going to get raked over the coals when they go out to borrow money, or are they going to pretty much get their feet kissed when they want to borrow money?
Feet kissed.
This is the feet kissing treatment.
I wouldn't call it feet kissing. I would call
As much
it,
as anybody gets feet kissing treatment.
yeah, it's still painful.
Relatively speaking, right?
Yeah.
Exactly. They're going to get the best terms possible. They're going to get the best terms available because they are, for a variety of reasons, the borrowers that lenders feel the most comfortable with. That leaves out a bunch of people. It leaves out a bunch of people. And that's where we get into, what did we say the opposite of conventional loans were?
Non-conventional.
Government.
Government.
Exactly. Government-backed loans. Now, let me say something before we even go down this road, because they're going to slide this in on the test, I can assure you. There is no such thing as a loan made by the U.S. federal government for purchasing a home. The government is not in the business of making loans. The government is in the business of insuring them. These loans are still made by banks. The banks will make any loan they can sell. In this case, though, they're not selling them to Fannie Mae, they're selling them to Ginnie Mae. And then Ginnie Mae will turn around and sell them to Fannie Mae, but the banks don't care about that. They just care that somebody will buy this thing. Does that make sense for you all? If somebody will buy it, the banks will lend it.
So isn't Ginnie Mae the government though?
Ginnie Mae is the government. That's exactly
So
right.
you just said no loans are made by the government.
That's right. They don't make loans. There's no application that Sheila can go fill out to borrow money from the United States federal government to purchase a loan. To purchase a house. You would go to Bank of America. You go to SunTrust. You go to BB&T.
Oh, got you.
And they would make you the loan. And then they would sell that loan to Ginnie Mae, who would then turn around and sell it to Fannie Mae. But there's no direct interface between the borrower and the government. Does that make sense now?
Yes.
Okay. So the biggest of this category of government-backed or government-insured or government-guaranteed loans is the Federal Housing Administration loan, the FHA loan. The FHA loan has been around for a long time. It does not lend money, but it does insure loans. It provides mortgage insurance. The loans are still made by the banks. So who sets the interest rates if you ask that on the test?
Banks.
The bank does. Who sets the fees if you ask that on the test?
The bank.
The bank does. The bank is making the loan. The bank is who the borrower is dealing with. All of the contact is between. So could Bank of America be at the same time making conventional loans and government-backed loans?
Yes.
Yes.
Absolutely. And they are all the time. Okay. So if a borrower does not qualify for a conventional loan, because that should be the starting point for any borrower. We just said conventional borrowers get the best terms. They get the feet kissing treatment. Well, everybody wants the feet kissing treatment, So if you're going to apply for a mortgage loan, where should you always start? What should be step one? If you're going to apply for a mortgage loan, let's try to get which one?
FHA?
Conventional.
Let's try to get the feet kissing treatment if I can get
Oh,
it.
yeah. Okay.
But start at the conventional loan. Does that make sense for everybody? You only end up in an FHA loan if you can't get a conventional loan, if you have any sense about you at all. Because the fees are always going to be less on a conventional loan. The terms are always going to be better on a conventional loan. This is a wonderful loan product if you can't get anything else. That's the way. Barbara says, why would a lender take this kind of loan? Because they're going to sell it. Let me ask you a question, Barbara. Let's say you own a restaurant and you hate spaghetti. You think nobody should eat it? You think it's the most gross thing in the world. But man, it sure is profitable because you can cook a lot of it and it's cheap and it sells like hotcakes. Would you have spaghetti on the menu in your restaurant?
Yes, yes, but if I was a lender, I would, I mean, I guess you could sell the loan.
There you go.
But if you were a lender, I'd rather just have the ones that can pay for it.
Would you though? If you had none of the risk, if you knew that it didn't matter because you're going to sell the loan. In fact, you already got a commitment that you can sell the loan before you make it. You don't have to go shopping it around. Somebody has already told you they'll buy it in advance. Why would you turn that borrower away?
So in all cases, the bad loans are sold to Ginnie Mae, or in all cases.
Pretty
You're
much.
never stuck with them.
Pretty much.
Okay, well then, yeah, why would, yeah.
And they get the commitment in advance.
Okay.
And by the way, even on the conventional loans, they get the commitment from Fannie Mae in advance. When they go, so here's the dirty little laundry secret of the lending world. When they go in there and they take your mortgage application and they say, okay, well, we're going to see if you qualify for our lending programs. They aren't even on their own website. They're logged into Fannie Mae's website, putting your information in. And seeing if Fannie Mae will commit to buy that loan. And if Fannie Mae says, yes, we will buy this loan, then they say, we're proud to qualify you for a Bank of America signature mortgage. They don't care. They're going to sell it. And the same thing is true of these government-backed loans. They're going to sell them.
So Travis, is this like the VA loan, like with military people?
Well, we haven't gotten to the VA loan, but that's going to be in the bucket of government-backed loans. The FHA just happens to be the bigger loan product. There are more of them out there.
Okay.
But it's coming. Yep. So if you can't, and I can't stress this enough, if a borrower can't qualify for a conventional loan. Now, I don't say that in a demeaning way. I'm just saying that if you knew that there were a certain group of loans out there that were going to have the best terms possible, and you're trying to get a loan, wouldn't you start at trying to get the one with the best terms possible?
Yes.
Absolutely. Okay. So you didn't qualify for the conventional loan. Fine. Let's look at an FHA loan. What you're going to find is a lot of what maybe knocks somebody out of qualifying for conventional will be allowed in the FHA loan. The biggest, by far, is going to be the down payment requirement. What did I say they were looking for mostly in conventional loans as far as a down payment requirement?
20%.
20%. They will accept higher if you buy mortgage insurance, but mostly they want 20% down. Guess what the FHA expectation is for a down payment? 3.5%. The expectation is for FHA borrowers that they only need to bring 3.5%. So if you've been denied a conventional loan because you didn't have enough money to put down, would an FHA loan be a good place to look then? What do you think?
Yeah.
Yes.
Absolutely. So this means it's a high loan to value loan, because if you're only putting 3.5% down, that means you're borrowing 96.5%. Okay. These are some characteristics that you might use to recognize an FHA loan. They are by law, because the federal government is insuring them. They can make laws about these. They can't make laws about conventional loans. They can make them about these because the federal government's providing the insurance. They require them to be fixed rate. There's no such thing as an adjustable rate FHA loan. The FHA provides mortgage insurance, which the borrower pays for on a monthly basis. And let me tell you, it is expensive. When I tell you that people should try to qualify for conventional loans first, you don't want to see what a conventional loan fee worksheet looks like beside an FHA loan fee worksheet. The mortgage insurance, just the mortgage insurance on an FHA loan, the current rate for it is 1.5% of the loan amount annually. That means if you owe $200,000 on an FHA loan right now, you're paying $3,000 a year just in the mortgage insurance. That's $265 a month, not in interest, not in principal, just in mortgage insurance. That is expensive, really expensive. But if you don't qualify for conventional, this will get you in. And so it is a great loan program for those who don't qualify for conventional loans. One of the big things they might ask you about on the test is this one right here. FHA loans require, not optional, not up for debate, what we call owner occupancy, meaning investors are not allowed to use FHA loans to purchase properties. If you buy it with an FHA loan, you're required to what?
Live there.
Live there. Now, they do have grace periods after a certain amount of time. If you want to convert the property to a rental, you can keep the FHA loan, but you don't know any of those time periods for the test. But what they might ask you about is this initial requirement for owner occupancy. It is felony loan fraud to take out an FHA loan for an investment property. So don't participate in that. Okay. As I mentioned, the interest rates are not set by FHA. They are set by the bank, by the lender. One other feature of FHA loans is the government does not allow them to have a prepayment penalty. So that's a good thing for the borrower. They can be refinanced at any time with no prepayment penalty. And these are the kind of loans that you probably do want to refinance because you want to get rid of that monthly government mortgage insurance payment once you've built up some equity in the property. So look at it this way. I'm taking out a 30-year FHA loan, but I probably won't keep it 30 years because at some point, hopefully in the first few years, I'm going to build up some equity so that I would qualify for a conventional loan. And then I would be much better off to go and refinance this into a conventional loan at that point in time, most likely. They are assumable loans. What did we say assumption was earlier? Somebody buys the property and they do what else in addition to buying the property?
They get the loan as well.
They take over.
Assume the loan as well.
They take over the existing loan as well. So, and listen, don't make assumption more complex than it is. It just means instead of there being two loans involved, there's one loan involved. Because normally you have a seller who's paying off a loan and a buyer who's taking out a new loan. In this case, the loan just transfers over from the seller to the buyer. The seller's still going to keep the difference, whatever amount they're going to walk away with the same amount of money, and the buyer's going to spend the same amount of money. It's just shifting the loan on paper. That's all it is. FHA loans are assumable loans by law. So that means that if you were to, let's say 5 years from now, interest rates are at like 7%, and Brittany bought a house in 2020 with a 3.25% 30-year fixed interest rate FHA loan. And she's now ready to sell her house in 2025. And interest rates are 7%. Would her 3.25% interest rate be attractive when interest rates are at 7%? What do y'all think?
Oh, yeah.
Very attractive. She's actually going to use that as a selling feature of the house. She's going to say, look how pretty the house is. And oh, by the way, you buy this house, you can borrow money at 3.25% because I have an assumable loan. You don't have to go out and pay 7%. You can take over my loan. And she's going to use that as a selling feature.
Can conventional loans be assumable?
Conventional loans can be, but most of the time they are not. Because there's no, the government can't make the rules for conventional loans.
Oh,
The government can make the rules for FHA loans, and the government says by law these have to be assumable. So that's why they're assumable. Because the banks get to write the rules with conventional loans, they could be assumable, but they most likely are not.
Brittany asked if it was hard to go from FHA to conventional if you refinance.
Not if you have the equity, because, you know, remember when you're looking at refinancing, they're going to treat you just like a new borrower. You're just using the new loan to pay off the old loan. That's all. But they're going to look at, they're going to simply say, how much are you borrowing? How much is the property worth? What does your credit look like? And if you meet all those criteria for, at that point in time, for a conventional loan, then they're going to qualify you for a conventional loan. And as soon as you borrow the money for the conventional loan, you're going to use that to pay off the FHA loan. And now you've transitioned from FHA to conventional.
Okay.
Just like taking out a new loan. The VA loan, which is the second big category of government-backed loans. The VA loan program, which stands for Veterans, the U.S. Department of Veterans Affairs, or the Veterans Administration, is a mortgage loan program that, again, the government is not lending money, but it is providing insurance or a guarantee for these loans in case of default. The key difference between an FHA loan and a VA loan is the loan to value ratio again. We said the key difference between conventional and FHA, the thing you would instantly recognize, that's not, the definition is one's government backed and the other's not, but the thing you would instantly recognize is the conventional, somebody put down a big down payment, and the FHA, somebody put down a small down payment. Well, what's smaller than small?
Nothing.
Zero. That's the VA loan program. The VA loan program is a 100% loan to value loan program. What that means is that the borrower, in most cases, is not having to bring any cash to the closing process. They are able to borrow 100% of the property's appraised value. Is that a risky loan? Is there a lot of risk involved in a loan where somebody makes no down payment?
Yes.
Yeah, there is. And for this reason, Fannie Mae would normally not touch purchasing this loan. But that's why Ginnie Mae steps in as the government, buys this loan, guarantees it, and then resells it to Fannie Mae. It has a guarantee on it from the federal government, just like the FHA loan does. In this case, the guarantee is for 100% loan to value loan rather than a 96.5. So the government's on the hook for more here, but that's the thank you. That's the reward for service. This loan is only available to veterans and their qualifying spouses, so widows and widowers would qualify as well. But the benefit, the major benefit, is this ability to borrow 100% of the property's appraised value. They call it a certificate of reasonable value in the VA appraisal process. It's called a certificate of reasonable value. And they will allow the borrower to borrow the full certificate of reasonable value, plus they will allow the borrower actually to add their closing cost into the loan. Because normally, even with an FHA loan, okay, I got to put 3.5% down, but I still have to pay my closing costs. I might have to pay an origination fee. I might have to pay interest up front. I may have to pay some fees up front, several $1,000s in fees up front, even with an FHA loan. But with a VA loan, not only will they allow the veteran to borrow 100% of the property's appraised value, they will allow them to borrow that amount plus the closing costs. Now, that's a really good thing for the veterans when they're purchasing, because they can purchase with no money out of pocket whatsoever. The one negative I would say about this, and this is really being nitpicky, is I think a lot of veterans don't necessarily understand this whole idea of being underwater from day one when they use the VA loan process. Because if you think about it, if you borrowed, if the home appraised at $200,000 and you purchased it for $200,000 and you borrowed $200,000 plus you borrowed your $5,000 in closing costs, or you tack that onto the loan, how much is your actual loan amount going to be?
Over the value.
205, but the house is still only worth 200. So the one downside, I think, is that sometimes veterans get kind of hung up in, especially if they decide they want to sell quickly, and they sort of feel like, well, did my house go down in value? Well, no, it's because you added on all of your closing costs to the loan amount. So it's a little bit of a double-edged sword in that regard, just FYI. But there's no special lenders for VA loans. Any banks can make VA loans. You don't have to go to USAA or Navy Federal Credit Union. Of course, the veteran can go to those places, but they should shop it around, because there are lots of lenders who do VA loans, and you may get a better price from somewhere else other than like a USAA or a Navy Federal or somewhere like that. All right. We say that veterans are entitled to their VA loan. That's actually a thing. It's called their entitlement. And the entitlement states an amount that a veteran can borrow under the VA loan program. It's an actual dollar amount. Like we have veterans in this class, and when they were separated from service, when they were honorably discharged, somewhere in their discharge paperwork, they have their entitlement amount to a VA loan, and it will be a dollar amount. And the best way to think of this is, you don't have to use all of it, but you can. You just can't use more than your entitlement. Can a veteran buy a home that's more expensive than their VA entitlement? Yes, but they, as far as the VA loan process goes, could only borrow up to their entitlement amount. Does that make sense for everybody?
Yes.
Mhm.
But it also means a veteran could have multiple VA loans at the same time,
Right.
as long as they don't exceed the amount of their entitlement. So if a veteran comes out of the service with a $400,000 entitlement, and they purchase a house for $200,000 and they're living there, and they think, man, this would be a good time to buy an investment property, they can take that other $200,000 entitlement and go out and buy an investment property. Because the other thing that doesn't come with the VA loan is this requirement of owner occupancy.
Right.
You can actually use it to purchase investment property as well. Are we all okay on the idea behind the VA loan?
Yes.
Who qualifies for it? Go ahead, Sheila.
I have a question. If you're a veteran, then can you get a veteran loan if you don't need 100%, or do you have to get an FHA? Like if you have an entitlement?
You can get a VA loan no matter what loan to value you want to do. What I would say is that if you have a substantial down payment, you'd probably still be better off with a conventional loan than a VA loan, because the real benefit of these loans is the 100% loan to value ratio. So if you were going to put substantial money down, you'd probably be better off in a conventional loan.
Okay.
That,
Brittany asked, doesn't the VA loans have restrictions on the types of property and things that must be done in order to continue with the loan?
all government-backed loans, FHA loans, VA loans, USDA loans, anything that the government is providing mortgage insurance on will have some minimum qualifications, minimum characteristics. The property will have to have functioning heating systems and cooking appliances, and if there's damage from termites, it'll have to be repaired. Those are part of the underwriting guidelines with these government-backed programs. But a lot of that has to do more with the fact that it's such a high loan-to-value ratio that there's concern that these borrowers might not be able to afford to fix any of this stuff if it didn't get done before they purchased. But yes, all government-backed loans do have some property requirements. And generally, that's going to be part of the appraiser's job. When they're doing an FHA appraisal or a VA certificate of reasonable value, is to note on the report anything that they notice that is deficient. And usually that'll have to be addressed before you could close.
Right. But would this one I'm sorry, Tasha, would this one be like, go ahead.
No, I was just saying he's right. That's all. Go ahead.
Would this one just be like the FHA loan where you could refinance it because it is such a high stake? Let's say, like, for example, my boyfriend, he is a veteran. He was in the Navy. So he is planning on going and getting a VA loan in September.
Yep.
So with him, could he go and then, like, after he's on the property and it's, generated a good amount of income and he's put on to the property, could he then go and refinance to do an equity? Thank you. I couldn't remember the word. Could he then go and get an FHA in order to make it a little bit better of a deal for him?
No, FHA is never going to be a better deal than VA. The terms of FHA and VA are going to be largely about the same.
I mean, conventional, sorry.
Now, conventional might be where he would see an improvement. It could very well be that he would see an improvement refinancing into a conventional, but a lot of that's going to be dictated based on what loans look like at that point in time. Because remember, interest rates change over time, loan fees change over time, so he would have to take a look around and see what was available at that point in time. But that could be something to look for in the future. Yes, once you've built.
I know, so he went a couple weeks ago and he talked to the people and they said, well, for the VA loan, you have to look in like certain areas. You can't have there's restrictions on the type of property and everything. And I didn't really, because I went with him and I'm like,
for
I
a
don't
VA
think that's
loan,
right.
USDA,
I was like, that's not right.
USDA loans are area specific, but not VA loans.
Yeah. I didn't think that was right. So he's going to get a second opinion because.
Yeah, now USDA loans are like that, but VA loans don't have those kind of restrictions on them.
I didn't think so.
VA loans are actually some of the most beneficial, honestly, as far as what, term. And here's the other thing. And this would never be on the test, so you can tune your test years out, but just for practical knowledge here, because I think it's such a big piece of information. If you are representing a buyer who has access to a VA loan program, if they're planning to do a VA loan, do not pry into their medical history, but you need to let them know that if they have any service-related disability rating at all, they will save thousands of dollars in fees on this loan because the VA will waive almost all of their closing costs.
Yes.
If they have any type of a service-related disability. It used to be you had to have at least a 40% disability rating to get that treatment. In recent years, they've dropped that to any disability rating. So just as an example, I don't know anybody who's ever been discharged from the Air Force that didn't have at least a 10% disability rating for hearing loss, just because of the turbofans. And so that, even that would qualify them to have all of their funding fees and almost all their closing costs waived. So I don't ever ask a veteran, well, do you have a service-related disability? That's none of my damn business. But what I say to them is, listen, just FYI, if you have a disability rating at all based on your service, we need to make sure the lender knows that so we can get these fees waived for you.
And if they ever have to like see proof of any of that or anything, they can just show their discharge paperwork,
Absolutely.
right?
Okay.
Okay.
And they'll need to see that. They'll need to see their discharge
Yeah.
paperwork and all that stuff. Yeah.
Okay.
Yeah. Well, I forget the name, the DV. Stuff.
Yeah. Like, I'm sorry to go off topic, but that just like, it kind of made me wondered of how that would work with everything.
Absolutely. But that's huge in representing veterans, just knowing that exemption, because you can say to somebody, because the lenders don't think to ask. You would think they would. They're doing a VA loan. You think they'd ask that question. They don't a lot of times. Now, if they do a lot of VA loans, they probably do. But sometimes they don't. And I mean, I have pointed it out and saved like $6,000 in fees for somebody. So it's a big deal. It's a big deal.
I mean, do you work with a lot of VA loans, considering we have like one of the largest military bases?
I don't anymore. I used to work with a lot more when I was, actively out there soliciting for business, and I worked with a lot more buyers. I did a lot more VA stuff. I'm not doing a lot of buyers right now, and the buyers I'm doing are generally like previous clients, personal friends, family, that sort of thing. And that circle for me is mostly like right now, Cary, Chapel Hill, which is not as military centric, obviously. So, I mean, I'm very aware of the programs and processes and step date on them, but I don't personally do as many transactions involving VA loans right now. But you don't have to go very far east of where I am. I mean, if you get, on the other side of Raleigh, south and east at all, you're pretty close to Fayetteville and Bragg and Goldsboro and, Pope. And, so you start to get into a lot of VA stuff in the eastern part of the state in particular. So, all right. That entitlement sets the amount that the veteran is qualified to borrow, and they get it back if they pay the loan off. As soon as the loan is paid off, they get their entitlement back. One of the most common test questions that people miss about VA loans is this one right here in the middle. They are assumable, and they can be assumed by non-veterans. Now, a non-veteran cannot take out a VA loan, but any of you can assume a VA loan as long as the veteran is willing to allow you to assume their loan. But here's going to be the catch. They're probably not going to be able to go get their own new VA loan if they allow you to assume theirs, because their entitlement would stay tied up with your loan until you paid it off. So while they can be assumed by non-veterans, it's not the most common thing in the world for them to be assumed by non-veterans, especially if the veteran needs to use their VA loan entitlement to buy their next home. They need to keep their entitlement. So, but they can be assumed by non-veterans. What am I elaborating on for Sheila here? Are VA loans appraised by FHA appraisers as well? It's a different certification process, Sheila, but usually the same appraisers are approved for both. Most residential appraisers have certifications to do conventional FHA and VA. So usually a residential appraiser will be able to perform, and it's just a matter of what goes on the report versus what doesn't go on the report as to the type of appraisal they're doing.
Is there any name for a VA appraisal or just an appraisal?
It's called a certificate of reasonable value. The VA appraisal is not actually called an appraisal. It's called a CRV, a certificate of reasonable value.
Thank you.
Yep. Those are the main types of loans: conventional loans, government-backed loans. There's a couple of little exceptions to the rule that we need to talk about real quickly, but largely we've covered everything there is to cover in finance. The first exception to the rule is something called a purchase money mortgage, or just called seller financing. This is a process where you are borrowing money from the seller and using that money to purchase their property. You are purchasing the property just like any other purchase. You're paying the seller for the property just like any other purchase. But the seller also happens to be a lender. They want to put on two hats at one time. They want to play lender. And so they've loaned you the money. They've stepped up and loaned you the money so you didn't have to go borrow it from a bank. That is seller financing or owner financing or purchase money mortgages. They all mean the same thing. Here's the thing. There's no different than any other loan. If you stop paying, guess what process the seller has to go through?
Foreclosure.
The foreclosure process. They have to have a promissory note. They have to have a deed of trust. It's just like any other transaction. Here's where they're going to try to trip you up on the test. They're going to try to confuse this with the installment land contract. And the reason they're going to try to confuse this with the installment land contract is because in both cases, you're making payments to the seller. Here's the big difference. The big difference is in this transaction, the property's already yours. You bought it. You paid for it. Title's been transferred. Whereas in the installment land contract, title doesn't get transferred until you've finished making all the payments. So this is much better for a borrower than an installment land contract would be. Because basically, the seller just became the bank. And you can pay them off early. You can refinance it if you want to. You can sell the property. You can do anything you would normally do with the property. It's just the payments you're making to your lender happen to be going to the seller because they're also the lender. That's seller financing. Pretty common in commercial property. A lot of buyers struggle to get financing for commercial transactions. And so, pretty common to see seller financing with commercial property. At least much more common than it is in residential property. Land transactions. See that? We talked about priority earlier in the way liens get paid off with foreclosures. But I also mentioned when I talked about, we said the first was the property taxes and first was the cost of the sale in the foreclosure, and then property taxes and special assessments, and then the mortgage notes in the order they were recorded. We said like 3A, 3B, 3C because there's a first mortgage, a second mortgage, a third. That's all we mean when we say mortgage priority. Mortgage priority just means that the ones that are recorded first get paid first. And that also means that if you're in second place or third place, you're at a higher risk of not getting your money. It's always worse to be further back in line than it is to be in the front of the line when it comes to this stuff. Final piece, couple laws we need to talk about here. This will definitely show up on the test. There is no doubt about the Truth in Lending Act and a test question, and particularly Regulation Z of the Truth in Lending Act. So this is going to be something you need to make sure you spend some time with and get it right in your brain what's going on here. This is a disclosure law. It's not for anything else. It doesn't say what fees a lender can choose. It doesn't say they can't charge fees. It doesn't say what the fees should be. It just says they have to do what if they're going to charge fees?
Disclose it.
They have to
The
disclose.
borrower now.
Tell them. Tell the borrower. Give them the whole picture. Does that make sense for everybody? And so basically, the Regulation Z of the Truth in Lending Act says there are 4 things that every borrower should be told about their loan if you're going to advertise to them and say, hey, come get a loan with us. If you're going to say, come get a loan with us, then you need to tell the borrower, number 1, what's the APR, the annual percentage rate of that loan? Number two, what are any of the finance charges you are charging, like origination fees or anything like that? Any finance charges that you're going to assess, what are those? Number three is how much is the monthly payment and how many, so the number and the amount of the monthly payments. That's number three. And then number four is right here, the total amount that the person is borrowing. Those are the four things that Regulation Z says every borrower should be told about their loan. Is everybody with me so far?
Yes.
Okay. Four things every borrower should be told about their loan.
So the Truth in Lending Act is Regulation Z?
Regulation Z is part of the Truth in Lending Act. The
Oh,
Truth
okay.
in Lending Act is Regulation A, Regulation B, Regulation C, Regulation H, there's like literally like 40 regulations within the Truth in Lending Act. But Regulation Z of the Truth in Lending Act is this little piece.
And that's what we need to know for the test, just
Yeah.
Regulation Z.
This is Regulation Z of the Truth in Lending Act. So why are you teaching me this stuff as a real estate agent? I'm not a lender. I'm not advertising loans. I'm not giving people loans. Why do you make us learn this crap? Here's why. The federal government has a very broad definition of what advertising a loan looks like. And sometimes we get sucked into that definition and we are not exempt. So what that means is if we accidentally advertise a loan, we had better be willing to also tell people what four things about that loan.
Oh.
The APR, the finance charges, the amount of payment, monthly payment, and how much people are borrowing. So what is the line in the sand? What does the federal government say is advertising a loan? And that's where this verbiage right down here, trigger terms, comes into play. The federal government says trigger terms are numbers. Let me say it again, numbers. They're numbers that relate to the loan. Any number that relates to the loan is a trigger term. That's why we get in trouble with this stuff. Now, the law doesn't say don't use trigger terms. It says if you use trigger terms, you have to be willing to give all these other disclosures. They're going to put that on the test, by the way. They're going to put an answer choice that says, the Truth in Lending Act, Regulation Z says don't use trigger terms in advertising. No, it doesn't. The Regulation Z of the Truth in Lending Act says if you use trigger terms, if you use these types of numbers in any advertisement, you had better also give these disclosures. Yes, ma'am, sir.
So if you say assumable loan or low payments, that would not qualify as trigger terms. You need to specify, give numbers.
That is correct. So a statement like assumable loan, low monthly payments, no money down, low closing costs, all of that is fine and not advertising a loan because it didn't use a number.
Numbers. That makes sense.
Numbers that don't relate to the loan are fine. 2,450 square feet. That's a number, but it has nothing to do with a loan. The list price, $325,000. It's a number. It has nothing to do with a loan. But if you say stuff like, own this house for payments as low as $800 a month. Well, the only way you get payments is if you get a loan. Now you're advertising a loan. Assumable rate loan at 3% interest. Now you're advertising a loan because you used a number specifically related. Does that make sense for everybody? So if you use a trigger term in any advertisement, you better be ready to give four things about that loan. What is the APR? what are the finance charges, how much is the monthly payment, and how many of those are going to be made, and how much is going to be financed. How many of you, I know we try to skip them now, but how many of you watch a car commercial on TV by mistake every once in a while? You know, like somebody trying to sell a car. What happens at the end of every single one of them?
Discloses like the APR and the financing charges.
They got somebody up there talking so fast you can't understand what they're saying, and all that fine print comes on the screen, right? It's all these disclosures that come from this law. Because what did they say during the commercial? Sign and drive, $99, and you got a car. Well, they're advertising a loan. And so they got to give all these disclosures. Does that make sense to everybody?
I mean, I think it's weird that a realtor would ever advertise a loan. Like,
well, you think it's weird until you see a sign in front of the house that says 100% financing available.
So is that like the broker is working with a specific lender and they're
well,
like,
no, they don't mean to be advertising a loan. But what I'm saying is the government says they're advertising a loan, whether they mean to be or not, because they use a number related to financing. So when they say 100% financing available, I'm sorry?
Like the real estate agent is just making up those numbers?
As far as we know they are. What I'm telling you is the law says if you don't have all the information, if you don't have the APR, if you don't have all that stuff, then don't use trigger terms, right? Because trigger terms require these disclosures. So here's what it would mean. If I wanted to put a sign in front of my listing that said 100% financing available, I'd probably have to go talk to a lender, get them to work up like a whole worksheet on all the fees, just so I could give that to people so I could say 100% financing available. Guess what I'm going to have my sign say? No money down. Because that's not a trigger term.
Zero money down would be a trigger term.
Zero money down would be a trigger term. Or just zero down. Yeah, because it has a number. So any number that could be remotely related to financing is a trigger term and triggers those disclosures. So as a real estate agent, now this is not what you're going to be tested on. As a real estate agent, I would just say stay away from trigger terms. Learn how to do it without them, because that's going to make your life a lot easier. What you're going to be tested on is, okay, we said this, now what do we have to do? And that's where those 4 things come in. We all good there?
Yes.
Okay. We talked about the Equal Credit Opportunity Act. Just another mention of that is it's a law that prohibits lenders from discriminating on the basis of race, color, religion, national origin, sex, marital status, age, how they get their money. Basically, there are additional protected classes under the Equal Credit Opportunity Act that are not there under the Fair Housing Act. And so that's what you might be tested on. Just make sure you understand that the protected classes are different for the Equal Credit Opportunity Act than they are for the Fair Housing Act. Every citizen, every resident of the United States legally has the right to 1 free credit report from each of the 3 credit reporting agencies once per year. So you can write off to them if you'd like a free copy of your credit report once a year. Of course, there are sites you can sign up for that'll do more active monitoring all the time, but you're entitled to 1 free one per year from each one of the companies. And the last little note in the chapter here is loan fraud is a felony. Don't do that. Don't participate in loan fraud. Here's how we define loan fraud. Any false statement made to a lender on a loan application or at any other time is felony loan fraud. The penalty is up to $1 million per violation and 30 years in prison. You do not want to be caught participating in felony loan fraud. And by the way, we have had real estate brokers in the last decade in North Carolina who went to federal prison for loan fraud. in real estate transactions. There's one lady in Charlotte. Look up sometime Operation Wax House, which was a federal investigation into a builder who was suspected to be committing loan fraud by intentionally inflating appraised values in the neighborhood. But here's what the builder basically did. They funneled money to their cousins and friends in other states to purchase the first few homes in a neighborhood at intentionally inflated prices. Because they knew that once you've sold 4 or 5, what does everybody look at when they're trying to decide what the prices in a neighborhood are? They look at what other things have what?
Sold
for.
That's sold for. So the builder was funneling money to friends and family out of state to purchase the first few homes in the neighborhood, inflate the price, so that future homes would sell for the inflated price. Their listing agent was not involved in that, but she did find out that it occurred about 2 years after the fact. And that came out in this federal investigation, that she became aware of it and she never reported it to any of the federal authorities. She never got a cent from it. She just got out of prison. She spent 8 years in federal prison. She had a 3-year-old and a 5-year-old at home when she went to federal prison, simply because she did not report felony loan fraud that was going on in a transaction. I relay that to you to tell you this is not worth taking the risk. If you see or hear anybody involved in a transaction who's giving false information to a lender, even as simple as, you know, somebody's getting an FHA loan and you know they plan to rent it out, would that be loan fraud? If they sign a statement on there saying, I'm going to live in the property, but you know they're already talking about who they're going to rent it to and how much they're going to rent it for, would that be loan fraud?
Yes, sir.
And you have a responsibility to report that to the lender. If you don't, you're a participant. And so I can't stress that enough. Just, it's not worth the risk.
So she just heard it and didn't report it.
Correct. 7 years in federal prison.
How about the builder?
The builder is still in federal prison and will probably die in federal prison.
Good.
Yeah. And in addition to something like 15 or 16 lenders in Charlotte who will probably die in federal prison. This was a major operation. She got by far the most lenient sentence.
So what happened to all the people who bought the property? I mean,
They got screwed.
oh my goodness.
They got screwed.
So-
But they paid inflated prices for the property.
If that happened to us, should we report that to our BIC?
Yes, if you see anything like that, you report it to your BIC and you report it to the lender, and you do that in writing in an email. Once you've given the information to, because we don't have a responsibility to go to the authorities. See, we have a responsibility to go to the lender. They're the ones who are being defrauded by the information. So if we take it to the lender and you turn it over to your BIC, you've done your job. And if somebody comes along and says, you knew this was going on, and say, yes, and I gave it to them, you're out of the picture. You're good.
Okay. As long as it's in writing.
That's it. That's exactly right. And what happened in this case was she found out what was going on, and basically the builder said, well, aren't you happy? Look at how many houses you're selling out here. You're making $200,000 a year. You really want to jeopardize all that? And so she didn't say anything. And needless to say, she also does not have a real estate license.
Yeah.
And I think that sort of went without saying, that the North Carolina Real Estate Commission permanently revoked her real estate license. So, but be careful. Don't do that.
Gary.
Yeah. That's it for financing. Look at that. A day of money. Other people's money. See, this is not money, it's commissions. Commissions are more fun because it's our money. This is other people's money. It's not nearly as fun. Okay? You got homework. Y'all got homework. I was not kind. Seth is going to send you an email with the, or he's already put it in the chat. Look at him. He's on cue over there. That is the quiz.
He already emailed it as well.
And I put it on the Google Classroom. And he's already emailed it too, it sounds like. You have the math worksheet. Now the math worksheet, don't feel like you have to finish all that tonight. That's a lot of work. If you want to, that's great. But I don't want you to feel like that's your assignment to finish that night. I'd like you to finish the quiz tonight. You know, but the math worksheet is something for you to work through, you know, as you get time. I would try to work on it some night, but if you don't get it all done, and I will post the answers to that as well. But that's in your OneDrive file as well. How many questions is the quiz? I think it's 23, 22, 23, something
It's
like that.
not a lot.
Yeah, I think it's something.
What's the math worksheet name?
It is named, I'll show it to you, interest and loan factor math problems.
Does it say 17 on it?
I think I probably did put 17 in there, but it's under the math worksheets, and it'll say something about interest.
You're so close. 24.
24 questions.
So you can do 12 and then 12.
And I can get
It says chapter 17.
it does say 17. I usually try to put the chapter number in there. Okay, good. Good. All right. I don't know why I said 17 when I put the name in it. That's what I just realized. That's why I feel like, never mind. See, I put the name up, but put the wrong name. It should be 14 and 15. But if it's so apparently I named it as 17.